Welcome everybody to today's webinar, How to Develop Profitable Trading Systems. I want to thank fxstreet.com for hosting and having me here today again. As you all know, I'm always on here the first Tuesday in a month from 11 to 12 Central Standard Time. So as the moderator said, what we'll be talking about today is developing a simple trading system. And this is the fourth part of our Profitable Trader series. And we talked about a couple of topics here in previous series, and we'll just very briefly in the first 3 to 4 minutes repeat some of the topics here so that you're all up to date. For those of you who missed the previous webinars, that you get an idea what we have been talking about, and the recordings are available on the fxstreet.com website, so you can review these webinars if you have missed them. What we did previously is that we did talk about the top 6 reasons why traders lose money, and here they are. The lack of a trading plan, the lack of discipline to actually follow the trading plan, the failure to control emotions. Emotions are so huge when it comes to trading. The failure to accept and limit losses, the lack of commitment, and overtrading. And so if you want to review these, and we had many examples, and I've shown you the mistakes, and I've shown you some ways how to avoid these mistakes, then please check out the recording of the first part of our Professional Day Trader series here on fxstreet.com. Okay, let me just make sure that everybody sees the same. I receive in the chat here a message that there's no screen. Do you all see right now the top 6 reasons why traders lose money? Just want to make sure that we are here all on the same page. Wonderful. So the moderator will help Pip Guru here. So we talked, the last time we met here a month ago, we talked about how to develop a profitable trading strategy. So we covered these 7 steps. We said the first thing that we want to do, I mean, this is actually step 0 if you want to, as a prerequisite. First of all, you define a goal. First of all, you say what you want to accomplish, and then you can make a plan how to accomplish it. So first, you need to write down how much money do you want to make with trading per month? And we talked about how to define a goal. We talked about SMART goals, specific, measurable, attractive, realistic, and a time frame. And please, if you did not attend last month's webinar, you need to view the recording so that you get the full value of today's webinar. Because what we're going to do today is practically we will develop a profitable trading strategy following these 7 steps that are outlined here. So after you have defined that you want to make X amount of dollars per month, you go ahead and first start somehow with an idea. And today we'll use Bollinger Bands as a trend fading system. Quickly talk about Bollinger Bands in the beginning of the session here, because you can use Bollinger Bands as a trend fading strategy or trend fading indicator. You can also use them as a trend following indicator. So there are various ways how to use Bollinger Bands. And today our system, our strategy will be based on Bollinger Bands. We'll be selecting a market. We'll select a time frame. We'll define our entry rules, and we'll then define our exit rules, our stop loss, our profit target, and our time stop. We will evaluate the system, and we will improve the system without curve fitting it. And we'll spend quite some time on this, because I see so many traders who are developing their strategy, and they are actually backtesting their system and over-optimizing the strategy based on historical data. You do not want to do this. So I want to show you today how to improve a system, how to optimize a strategy without curve fitting it. And if we have time towards the end of the session, we will test it on multiple markets. And if you do have any questions in between, please type them in the chat. I will be checking the chat from time to time. I might not respond to your question right away, but we certainly have some question and answer time towards the end. So I've timed it here perfectly that this time we have a couple of minutes towards the end. Also, besides the recording that you will receive here from fxtrade.com, if you want, I also have a script for this part of the Profitable Trading series. So if you're interested in a script, and this will also, it will not only outline the strategy that we'll be developing here, it will also outline all these 7 steps in more depth, basically what we covered the last time. And if you're interested in this, at the end of the session, I will give you our email address where you can quickly email in and we'll send it to you right away. I think it's around 40 pages, so it's a nice ebook that you can have here. All right. Perfect. Ivan, I will talk about curve fitting when we get there. How about that? Okay? So we'll do this. Let me see if I have another slide. Yeah, this is what we want to do. So we want to start with an idea. And in a minute, I'll show you here my charts with Bollinger Bands. You see, Bollinger Bands actually consist of a center line, which is a moving average, and 2 price channels, one above the center line and one below, which are standard deviations of this moving average. Now, the fascinating thing of Bollinger Bands is that they contain up to 95% of the closing prices, depending on the settings. And we'll test various settings today throughout this session here. So what we would like to do is we want to use very simple entry rules. We want to sell when prices move above the upper Bollinger Band, because as you know, 95% of the closing price are within the band, so there's a good chance that they're moving back inside the Bollinger Bands on the next bar. Also, the opposite, we want to buy when prices move below the Bollinger Band. So the main idea I said is prices should move back inside the Bollinger Bands on the next bar. As an exit rule, in the beginning, we want to keep it very, very simple. In the very beginning, we want to use no stop loss, no profit target. We just want to reverse the trade. So basically what we are looking for is that prices are bouncing back and forth between the upper and the lower Bollinger Band. I'll show you a couple of examples here. Okay, this is the time where I switch over to my charting software. So let me quickly refresh the screen, get rid of the presentation, and at the same time bring up the charting software. So 1 second here. All right. Good. Here we go. We do not need that. Perfect. Okay, we are back. You should see my charting software right now. So what you should see on the screen here is actually, I've been speaking the euro versus the dollar. So we will talk about markets and time frames here in a second, what we want to do. And please keep in mind all the comments that I did last time about picking a market and picking a time frame. So step number one, after we had the idea of trading the Bollinger Band, what we would like to do now is first select a market. And since we are here on fxtrade.com, I thought we are choosing a Forex market. So how about that? Here's a Forex market, and the most popular currency pair in the Forex market is the euro versus the dollar. So I thought I show you the euro versus the dollar. Now let me explain a little bit what you see on the chart here right now. First of all, I've been choosing 60-minute bars. So these are 60-minute bars of the euro versus the dollar. I plotted the Bollinger Bands here, and the settings that I used for the Bollinger Bands, as you can see, is the closing price, or the moving average of 10 bars. So the moving average is over the last 10 bars, and also the upper and the lower Bollinger Band based on the last 10 bars, and a standard deviation of 2.5. Now, if you pull it up on your charting software, in most charting softwares, what you'll see is that Bollinger Bands have a standard setting of 18, 20, or 21, depending on your charting software. So some charting softwares have a standard setting of 18, others of 20. Now, the reason why they do is because John Bollinger originally suggested if you use Bollinger Bands, you should use a setting of 20. However, John also says that you should use a setting of 20 or 21 if you are trading on daily charts. If you are moving to a lower time frame, and you can look this up on BollingerBands.com, I think it is BollingerBands.com, on John Bollinger's website, he says if you are moving to a smaller time frame than 1 day, you should shorten the number of bars used in the moving average. And John himself suggests a value of 10. Also, if you are changing to a time frame larger than daily, you should use a larger time, more bars for the moving average here. Okay, we'll talk about the setting 2.5 here in a little bit. So this is why I'm displaying the bands here. And the main idea is, as you know, depending on the settings, Bollinger Bands contain up to 95% of the closing prices. Now, depending on the settings of the standard deviation. So the standard deviation, again, as Link's tip said, usually is 2.0. The higher the setting for the standard deviation, the more closing prices you have within the Bollinger Band. And now it depends how exactly you want to use the Bollinger Bands. And we talked about it the last time. There are basically two different categories of trading strategies. One is a trend following strategy, and one is a trend fading strategy. So what we are currently using here is a trend fading strategy. So if you're using a trend fading strategy, of course, you want to have as many closing prices within the Bollinger Bands as possible. And this is why I increased the standard deviation from 2 to 2.5. So this is what you're seeing here, the settings 10 and 2.5. So the main idea is, what I said, as soon as prices are moving outside of the Bollinger Bands, we want to sell. For example, want to sell here, okay? As soon as prices are moving above the band. So we are selling at 152.34. The very similar rules right now, as I said, no stop loss for now because we need to get started somewhere. So we'll do this as we go along here. No stop loss, no profit target. All we want to do is basically just use the reversal signal, and we want to buy as soon as prices are moving outside of the lower Bollinger Band. Here, you see the value of the Bollinger Band? Can you all see my arrow here? Is right here at around 151.86. So this morning, we would have sold, was it this morning or yesterday? It's the 4th. No, it was this morning. 3rd, no, here, yesterday. So we want to sell here, we want to buy back here. Again, a reversal signal. So where do we sell again? We sell again here, okay, when prices are going up here. So we make some money when going down here. We make some money when going up here. So we sell here again. When do we buy the next time? We buy again, in this particular example, as soon as Bollinger Band, as prices are moving outside of the Bollinger Band. You see here they are touching the Bollinger Band. Here they are moving outside of the Bollinger Band. So sell, buy, Makes sense so far? Okay. And then sell again here. Sell again here. And right now we'll be short. And you see prices have been going up and down. And we are right now moving down our entry price. And right now our buy signal at this point would be here. So this is where we want to buy back. So we are in a short position right now. Okay. So just regarding the main principle, does this make sense so far? Do you understand the main idea that we are having here regarding the Bollinger Bands? So far so good? All right. Perfect. So let's program the strategy around here and then take a look at some initial results that we have here. Now, what I'm going to do, the software that I'm using here is Genesis Trade Navigator. I found it very reliable. I've been using it for many years. And you see I've been using basically all kinds of different software. I've been using eSignal, FutureSource, TradeStation, Metastock, Ensign. I mean, whatever is out there, OmniTrader, I think I used it one time. Basically, I've been using it. I've been programming on Strategy Run. I have been programming on NinjaTrader. It doesn't really matter what you do. So let me just quickly bring up my strategy here. And now it might get a little bit tricky. Let me bring up the strategy. We have to use it differently because I'm forced here a little bit to work on a small screen. so that the recording is properly. So let me apply the trading strategy to the chart, and this is the FX strategy that we are having here. And let me just edit the strategy and show you exactly what I did. And I'm trying to center it here right now, and you see it goes a little bit to the right-hand side of the screen, so I try to work with a small screen size here as good as possible. See, I have a long entry here where I basically buy at the lower band, and I have a short entry where I sell at the upper band. You see, I'm using here two parameters in this strategy, which is BB bars, where I can specify how many bars I want to use, and the standard deviation, because these are the only two parameters I have so far, since we're using a very simple reversal strategy. So these are the only parameters that I can actually vary. And see what I want to use here in the beginning as inputs, so that we have exactly the same data as we have on the screen. I want to use a value of 10 for the Bollinger bars, a value of 2.5 for the standard deviation here. And regarding this, the data, I want to go on 60-minute charts. Remember, first thing we do is start with an idea. So the Bollinger Bands are here our idea, trend trading system. Want to select the market. So as a market, we selected the euro versus the dollar. And as a bar period, we will start off with 60 minutes. Why not? Let's see, and then decide how we can optimize it for different time frames. So what I want to do is, for the past couple of years, you see for the last 2+ years, I want to run this simulation here and see what would my results have been if I used exactly this parameter with the idea. And it's going back now over a couple of hundreds, maybe a couple of thousand trades. And the reason why I like Genesis Trade Navigator here is because they're doing it tick by tick, so not bar by bar. They're using this precision tick algorithm, and this is why it takes a few minutes. And you see, I want to do it live with you here so that you see exactly what is going on, even though it might take a minute longer or so. So while we're waiting here and the strategy is backtested, let me answer some questions. What do we have here? So Len is asking, are you waiting for a close outside the Bollinger or getting in early based on the actual move of the candle beyond the band? Well, Len, what I do is I place a limit order to sell at the upper band. So this means I'm not waiting for a close outside the Bollinger Band, because if I would wait close outside of the Bollinger Band, it would rarely occur, because 95% of the closing price are within. So as soon as prices are moving outside of the Bollinger Band, this is when I actually want to sell. Same for the down, I'm placing a buy limit order at the lower Bollinger Band. Okay? So here are the results, the preliminary results of this performance report. And we talked about it, how to read a performance report the last time we were together here in the webinar. So overall, it seems, well, at least we have a profitable trading strategy. That's a plus, right, isn't it? At least we have a profitable trading strategy. Overall, over the past couple of years, we made over 1,000 trades based on the 60-minute bars, and we made $22,000. So this means that in average per trade, we're making $22 here. Now, the overall drawdown seems to be quite high. So we are having a drawdown of anywhere, closeout drawdown or intraday, between $8,000 and $9,000. But the winning percentage is quite encouraging. So we have a 70% winning percentage here. The maximum consecutive losses has been only 5, as you can see here. So that's good for our confidence. So we know over the past 1,000 trades, we had a maximum of 5 consecutive losses. So just some key statistics, and please refer to the previous webinar if you want to know exactly what we are looking at. Percent in the market, we are almost always in the market, since we have a simple reversal strategy. And the reason why we are not in the market all the time is because sometimes we have some holidays where we do not trade. So this is the initial results that we have here. Let's take a look at the equity curve, and let me just remove, what do we have here? It's a moving average that I see here. Let me see if there's any way I can remove this. I don't see it right now. Doesn't matter. So this is how our equity curve looks like. And you see, overall, it is not too bad. We're making some profits. But you see that we also have a couple of months where our equity is going down. So you see we had a peak of $30,000. Right now we are $22,000. So as you can see, there's definitely some room for improvement. But in the first draft, what we want to see, do we have a good idea that we can use and where we now can play around with the entry signals, with the exit signals, maybe with time frames. So the first thing that I would like to do is I want to see, can we improve the system by maybe changing the time frame. You see here on 60-minute charts, again, we had $22,000 and we had an average trade of $22. So let me just jot this down here since we want to have the comparison. And let me run a quick performance report backtest here on 15 minutes. And you know what I would like to do right now so that it doesn't take so long? I'm going back to 2006 so that we might have around 800 trades, because otherwise it'll be here probably forever. So we might have another minute or two where we wait for the results and see if changing the time frame to a smaller time actually improves our strategy. What would you think? Well, what will happen right now? We talked about the last time. So for those of you who have been in the webinar line, what do you think will happen if we change to a smaller time frame? Will we achieve better results or worse results, or any ideas? Worse results? Yeah, very briefly, what we talked about is the smaller the time frame, the smaller the average profit per trade, right? The larger the time frame, the bigger the average profit per trade. So what we can expect here is that we will have more trades. Thank you, Stoyan and Pip Guru. We will have more trades, but overall we might have a smaller profit per average profit per trade. So instead of $22, we might go down maybe to $17. And you know what? I'll be as surprised as you are. Because I haven't been running this optimization strategy here for a couple of weeks. So I honestly do not remember. So certainly we'll get more trades. Here we are. Look at the results. Isn't that interesting? First of all, of course, even though we are trading a year less, we have more trades, of course, since we shortened the time period from 60 minutes to 15 minutes. So obviously we have more trades. Look at this. The winning percentage went up. Good. The winning percentage made up. Overall, more profits. Absolutely. From 22,000, we went up to 61,000. And the average profit per trade went up from 22 to 28. The drawdown is comparatively, it's almost the same. You see, between $8,000 and $9,000. But instead of having $22,000 in profit, we now made $61,000 in profit. You see, this is why it is a systematic approach. Developing a profitable trading strategy is a systematic approach. And before you start playing around with the parameters, you start playing around with the market and with the time frames. So just checking it out, how does the system, is this a system that is better, obviously, for smaller time frames than for larger time frames? I do not want to go through daily and weekly, but you know that there are some major time frames like 5-minute, 15-minute, 30-minute, 60-minute, daily, weekly, monthly. So you want to test these time frames first. Keep in mind, step number one, selecting a time frame. So for now, let's stick to the 15-minute bars because it seems that overall we are getting better results here. Let's take a look at the equity curve here. Look at that. It is much smoother than the one we have seen before. Okay? So here we have a way smoother equity curve. The red line is actually the equity curve. The blue line is an equity moving average. Don't worry about this. So this is how your account should have been developed if you have traded this strategy in the past. Okay, keep it in mind. We're backtesting here. So this is where we got nicely up to approximately $60,000. And you see that in the past couple of months, we are here trading around the same. So the markets have been a little bit more trending. And keep in mind, there's a trend fading strategy. So we like markets that are just going sideways on 15-minute bars. So this is what happened here over the past couple of months. Basically, since October, this strategy has been flat. But you see, overall, we have not been losing too much money. I mean, we made a lot of money. We gave some money back to the market. So we'll see. However, still room for improvement. So let's start doing this. So after we settle on the 15-minute time frame for now, what we want to do is we want to refine our entry signals. So what we would like to do is take a look at the Bollinger Bands and see if any other value than 10 would be good. So what I would like to do here is basically, let's try to go for lower values, and let's also try to go for larger values. So what I would like to do is I want to test here the bars for the moving average, anywhere from as little as 2 up to 20 bars used in the moving average, just to see how our value of 10 is doing here. And this is right now where I want to go into the subject of not curve fitting. So let me run the optimization here, and let's wait for the results coming in. As I said, what I would like to do, I would like to test this strategy on 15-minute bars if I'm using for the Bollinger, for the moving average for the Bollinger Band as little as 2 bars up to 20 bars. So let's see, and while this strategy is backtesting, we should already see some results popping up here. And Boyke, I'll take a look at this in a little bit. I mean, if you can expect an $8,000 drawdown, I would certainly have at least an account size that's twice as big, right? So at least $16,000, 16, maybe preferably $20,000. And so let's see if this is coming up here. And don't worry, we are all good in time. So we have another 15 minutes. And let me bring up the optimizer from the other screen, because it's appearing here on my other screen. Let me move this over. Okay, hold on. Here we go. So we'll take a look at the results that should appear here in a second. And I might want to change the time period that I'm using here, just for the sake of speed here during this webinar that I'll be using. So let me bring up the charts again. Hold on 1 second, and do the optimizer. Okay. I just thought, I mean, and I apologize that we have here a small 2 or 3 minute waiting time. I just thought it's a little bit cooler if we do it live than I have it canned and recorded in presentations, right? So I hope that you're fine with this, that you're really seeing I'm not manipulating the results in any way, and just create some nice tables here. Now what you can see is, first of all, we have the first 2 results. If we use a very, very small setting here for the Bollinger Bands of 2, take a look at it. Overall, we're taking way more trades, 15,000 trades, and this is the reason why it took so long here to come up here. We made a profit of $352,000. The average, no, we have to look for the average profit per trade, and therefore I have to scoop it over here a little bit. So the average profit per trade that you should see coming up here on the right-hand side. Okay, I have to scoop it a little bit over. The average profit per trade for this small setting of 2 went down to $23. It'll come up here in a second again. To $20. And also the drawdown went significantly down. So let's take a look at this again. Oops, where's my optimizer? Here we go. You see, what we can do is, if we use a smaller, if we use a small setting for the Bollinger Bands, and please keep in mind what John Bollinger says about his bands, the smaller the time frame, the fewer bars you should use in moving average. So here's the statistical empirical proof that it is true. You see, we can bring down, we can turn our net profits up to $350,000 in our average trade. Slightly reducing to $23, but look at the drawdown. Instead of a drawdown of $8,000 to $9,000, we could reduce the drawdown to 1655. And I'm sorting here, you don't see this on the left-hand side. I'm sorting here by bars used in average. So this is for a number of 2 bars in the used in average, 4, 6, 8, 10. You see, this is our original results that we had with bars used in average of 10. The average profit per trade of 28, you remember, $60,000 and a drawdown of $8,000. See, anything around and above 10 is yielding in approximately the same drawdown. So we have here a drawdown of $8,000, $7,000, $7,000, $8,000, and then we go up to $10,000. So the optimization is done here. And as I said, I have to use here very small screen resolution. What you'll see, I just sorted it, the number of bars used, 2, 4, 6, and so on and so forth. So we can see basically the smaller the number of bars using moving average, the smaller the drawdown. So why not use here this this setting of 2 and see how it looks like on the chart. So let's use the value here of 2 actually. Let's save the strategy. Let's go back to the bars, to the charts, and then we take a look how this looks like. So we need to adjust the settings for the upper Bollinger Band and the lower Bollinger Band to 2. You remember, this is what we just did. 2 and 2.5. Let me do it here. And also, if you want to display the moving average, I'm not displaying the moving average. We don't need this. We just need the upper band and the lower band. So you see the upper and the lower band are now much closer together. You see, we do not capture the large swings here as previously. Remember? Previously, we had a setting of 10, so we went short here and we went long here. We went short here and we went long here. So now we are basically nibbling the market, as you can see. We're just going for a few pips. See, here we would be going for 50 pips. A 50 pip swing here, a 50 pip swing here, another 60 pip swing here approximately. Now you see that the blue arrows are depicting the long signals, and then the red arrows are short signals. So basically, as you can see, we went long here at a price of 159.94, went short here at 152.00. So you just went for 6 pips. 6 pips. Not pigs. We're not trading lean hogs here, right? So you see, we're really nibbling the market. We are making small but consistent profits here. Oh, the time frame. Thank you, Barky, for reminding me. Thank you. Who else paid attention? 15 minutes. This is where we have to change the time frame for. And Nico is asking, do we need to target a positive drawdown? No. I mean, you cannot have a positive drawdown. A drawdown is always negative. I mean, it's basically the difference that your account moves from a peak to a valley. And Stoyan, I use 2 pips here as the spread. So when backtesting, I'm using an assumption of 2 pips for the spread. Yes, Stoyan, this is what I do. Okay. Thank you, Barky, for pointing this out. So we are now down to 50 minutes. This is exactly what we have been using here. And you see, this morning we had also a small loss. So we went short at 52.18, and then we had an 18 pip loss actually. Here we made some money back. We lost some money, so this is part of the game. But our losses and profits are overall quite small. And since we have a 70% winning percentage, we are making more profits, or we are making more money than we are actually losing here. So let's take a look at the equity curve maybe very quickly, at the performance report for the strategy here. And I'm just doing it quickly over the past 500 trades. You see, I'm right now just doing it to be a little bit faster. And this is how the equity curve looks like over the past 500 trades. So overall, it's not bad. I mean, you see that the equity curve is nicely moving up. So overall, regarding our entry points, we made a good choice. And remember, we are going through a multiple-step process here. What we want to do, first, select the time frame, 50 minutes. Selecting a market, euro versus the dollar. Selecting the entry signals, and it seems that here a small setting for the Bollinger Band is producing better results here. And Barky, absolutely, your broker will be very happy. But I mean, as long as you keep making money here and have an average trade of $22, after a 2 pip commissions, why not? 73% winning percentage. So the average win in a trade is $63 here. The average loss is $95. The largest loss that you have experienced over the past 500 trades has been $600 here. I mean, not too bad. And the overall drawdown over the past 500 trades has been $1,400. And you know that previously I tested it on several thousand trades, but for the sake of speed here, we want to do this. Okay, let's talk about stop losses and profit targets. Let's see if we can improve this strategy. So what's the starting capital? Well, I would always look for the maximum drawdown, and then I would at least double the maximum drawdown and start with this. So if you see that the as maximum you could have lost $600 and the drawdown was around $1,600, I would for sure start with $3,500 to $5,000 just to survive a drawdown if you run into a drawdown. Okay. So what do I want to do? Okay, let's think about stop losses, because you know so far we do not have any exit rules. All we have so far is entry rules, and we are just reversing the entry. So let's see if we can do anything if we edit the strategy and if we add a stop loss. So I want to add here a stop loss for a long exit and a short exit. And what I would like to do, let's just do it here simultaneously. Let's maybe apply a stop loss of $100, 10 pips. No, it's not too much. It's still at 30 pips, $300. So this is the stop in dollars. So around 30 pips is what I would like to use here as a stop loss. Now what I can do, it's pretty neat, is that I can say, well, show me once the results for using the stop losses and once the results for not using the stop losses. So this is what I can do here with my backtesting software. So I should have reduced the dates, because we're now trading on the backtesting period. Since we are trading on 15-minute charts, I could have shortened it to a couple of months, maybe somewhat like 6 to 8 months. Okay, but however, I'm doing it now, I think way back to 2006. This was my setting here. Well, Stoyan, just to answer your question while we are waiting here, the way I've set it here in my backtesting software, I set the starting capital to 0 here, because I just want to see how it develops. I mean, if you want to start off with $5,000, the whole equity curve moves $5,000 up. I mean, what you want to see, and this is why I like to have the 0 line here, you want to see if you start off with $5,000, does it ever go below your starting capital, or does it go above? And so it really doesn't matter if you're using a 0 line or not. This is only important if you use money management techniques, and for money management techniques you want to specify what starting capital you use here. So again, this is here, please, what we're doing here, do not, warning, disclaimer, do not start trading this strategy now right away as soon as you go out of this session. Use this as an idea. We talked about it. What we want to do here is some education. We want to show you how you can develop a profitable trading strategy, going through the 7 steps that we are having here. So going through the 7 steps, we are now at 4 defined exit signals. And you see the way how this works here. Actually, we want to apply rule number 1, which is the long exit, a stop loss, and apply an exit short stop loss. So if we apply a stop loss, we achieve a winning percentage of 76%. Now it is in the second line. We make 15,000 trades over the time period that we have done here. We make a net profit of $347,000, and I'll scoop it over here a little bit. So as soon as we have the results, that you see all maximum drawdown and the average profit per trade. Actually, it is testing it rule by rule. So the results that you see here is basically if we would not apply a stop loss to our long exits and only apply a stop loss to our short exit, which of course does not make too much sense, right? But you see, these are different possibilities that you can do. And this is where some traders run into the problem of over-optimization, okay? So I would always, if you use a stop loss, you want to use a stop loss for both long entries and short entries. And all I want to do right now is want to see if using a stop loss actually improves my trading strategy, and if so, what kind of stop loss should I use? I mean, right now you choose arbitrarily 30 pips. Yeah, so want to see if it's better if you use 20 pips and 40 pips and so on. So you can see basically if you would not be using any stop loss, without any stop loss, we had a net profit of $352,000. We have a winning percentage of 76.8%. And if you would use a stop loss, and that's the last row here, our winning percentage would slightly drop down, and so would our profits. What can we talk about the average profit per trade? It is approximately the same. And you see, not using a stop loss, our maximum drawdown over the testing period was $1,600. By using a stop loss of 30 pips, our drawdown goes up to $1,800. So basically, by using a stop loss, we are increasing our drawdown. However, we are just slightly increasing our drawdown, and you know this, we talked about it several times. Good traders always have a stop loss in the market. So here you see adding a stop loss does not really improve our strategy, but it also does not worsen our strategy, so it doesn't make the results worse. And it's basically like an insurance, and therefore I would definitely place a stop loss in the market. What we can do right now, and this is then the last thing we might want to do here, try to vary the stop loss, and instead of using, and what I will do right now is I shorten just the time period that I want to use here. So I basically go for, I don't know, maybe since August 2008. And please, again, August 2007. I just do this for the sake of time, saving time here in the webinar. Please, when you're backtesting, use as much data as you can. Okay? So want to do this, want to apply this from August 1st to now. As an input, we want to vary the stop losses. So we want to use our stop losses, and then we want to see how our stop losses do, applying a value of maybe 100 to, 600, and with a 5 pip increment. So this is $100 to $600 in increments of 50. So we want to see anything between 10 and 60 pips. So let's quickly run it here and see how the results improve. All right, and this is the last thing that we're going to do, and then we'll wrap it up here. So we have 5 more minutes. If you do have any questions in between, please ask them right now while we're waiting for the results. And Stoyan, if your testing software does not allow you to start with, I would always start maybe with $5,000 or $10,000 and then adjust it properly. Okay, so start with 5 or 10,000. So let's quickly do it here. And again, keep in mind, this is a systematic 7-step approach that we are using here. First, start with an idea. Then you select a market. Here we tested the euro currency versus the US dollar. Want to select a time frame, and you remember we started out with 60 and then we tested a time frame of 15. You want to, of course, test other time frames. Maybe there's better results on 30 minutes. Maybe there are even better results on 5 minutes. Maybe the best results are on daily. At this point, I do not know, because I can quickly give you a brief overview here. And this is again why I said, do not start trading this strategy. Use the idea and do your own backtesting, your own testing based on the 7 steps that are out. So the next step then is defining entry rules. We use very simple entry rules here. Jitendra, if your tool does not support 2.5, test it out. Test it with 2 and test it with 3 and see where you have the better results. I mean, it's a step-by-step process here. Now we are adding a stop loss, and we'll see what stop loss would produce the best results. And you see, if you're using a very tight stop loss here of $100, your profit already goes down from $350,000 to $134,000. So obviously, for this kind of strategy, it seems that you should rather apply a larger stop loss. And to be honest, for a Forex trader, a stop loss of 30 pips is not too much, right? I mean, 30 pips, everybody can survive a 30 pip hit. I hope so. If not, you really need to work on your trading account size. See, the higher the stop loss here, the better the results are. So we're going up in our net profit. We're going up in our winning percentage. We're going up our average profit per trade. And Soren says, when you test a new strategy, use the same amount of starting capital as my live account. Very smart idea. Great. Okay. So very good idea. We are testing different stop loss right now. Now, the next step will, if you remember, testing profit targets. Not only a stop loss, or testing a profit target. Another exit that we mentioned is a time stop. So you also want to test the time stop here. Then you want to evaluate your trading strategy. Again, very important. Test it on multiple markets. If this works in the euro versus the dollar, it should work in the dollar versus the yen, in the pound versus the yen, in the pound versus the dollar, and so on and so on. So you want to make sure that you test it on multiple markets. Okay, so this will show us basically the results. I'm going to cancel it here right now, because what I would like to give you is, if you want to have an in-report where you actually, or basically these 40 pages that I talked about, where you can read through the 7 steps, and also I'm presenting this very simple strategy here, please do send me an email at support, I'm typing it in the chat right now, support@rockwelltrading.com. Okay, or you can visit our website at www.rockwelltrading.com. Okay, and look for the special report here. And also fxstreet.com makes it possible as a service to you to have the recording. And what I will do is, as soon as we get the recording up on the website, we'll send you an email letting you know that the recording is up there. It usually takes a few days, so wait for our email here. And if in the meantime you're interested in this special report, just send an email to support@rockwelltrading.com. All right, guys, this is what we did here. And Boyke asked a very good question. Does past predict the future? No, of course not. So what you want to do, if you tested this idea in the past, you now want to test it on a paper trading account, on at least 40 to 60 trades, and we talked about this, to see if this still applies right now in the current market. And what we will do in the next session is, I will present to you the 10 power principles of profitable trading strategies that you can apply towards your trading strategy that you're actually trading, to make sure that this trading works when it hits the real markets. So this concludes today's session. I thank you very much for attending. The next session that is coming up is a premium session. I'll be back here in the first Tuesday in April. The first Tuesday of April, we'll be back here and we'll talk about the 10 power principles as the 5th part of the Profitable Trader series. Thank you very much, everybody. And it will be on April 1st. How interesting is that? Perfect. Thank you very much. You have a great afternoon or a great evening, and I'll talk to you soon.